If you look at investors in franchising over time, some portfolios start building momentum, while others feel like they're being managed, adjusted, constantly worked on just to keep things moving. And it's not because one group is seeing better deals or getting lucky. It's because they're structuring things differently from the beginning. I'm Justin Kaiser, CEO of Empire Franchising, and I've spent the last 25 years building, scaling, and investing in businesses, including taking my own franchise brand from 0 to over 100 franchise territories in 3 years before an acquisition at the end of 2024. Now, one of the biggest shifts that I've seen is this. Investors who get consistent compounding results don't think in terms of individual deals. They think in terms of how everything connects. Because most people approach franchising one opportunity at a time. They see a brand, they evaluate it, they decide if they like it, and then they move on. That works in the short term, but over time, it creates a portfolio that feels disconnected. One investment might be an early stage with no cash flow yet. Another might be mature but not growing fast. Another might look good on paper but requires more attention than expected. And now, instead of building momentum, you've got a collection of assets that all behave differently. And all of them need something from you. And that's where friction starts to show up. Because now you're not managing a system, you're managing a set of unrelated outcomes. And that's a very different experience. Now, compare that to a portfolio that's been structured intentionally from the beginning, where there's thought put into timing, into how capital flows, into how each piece supports the next. Because franchising, when you really understand it, isn't just about owning brands. It's about understanding how money moves through the system over time. You've got upfront franchise fees, which can generate earlier stage liquidity when the sales engine is working. You've got royalties, which take longer to build but create recurring long-term value. Then you've got other layers that develop as the system grows. Vendor relationships, marketing contributions, operational efficiencies that improve margins over time. And when those are spread across multiple brands or systems, something changes. You're no longer dependent on one timeline. You're no longer waiting on one outcome to validate the entire investment. You start to see activity across the portfolio. Some parts generating cash flow, others building value that shows up later. And that balance is what creates stability. And stability is what allows you to make better decisions. Because you're not operating from pressure, you're operating from position. Now, layer in something even more important, reinvestment, because this is where compounding actually becomes real. When capital starts coming back from one part of the portfolio, instead of sitting idle, it gets redeployed into systems that are already working, systems that have already been tested, already refined, and the cycle starts to tighten. You're not starting from 0 each time. You're building on top of what already exists. And that's when things begin to accelerate, not in a forced way, but in a way that feels like the system is starting to move on its own. That's what a well-structured portfolio feels like. It feels like momentum, not constant effort. Now, the opposite of that is a portfolio that always needs attention, always needs decisions, always feels like you're trying to line things up just right, always feels like you're one adjustment away from it working the way that you want it to. And a lot of investors find themselves there without realizing why. Because on the surface, the deals looked good. The logic made sense. The numbers checked out. But there was no connection between them. No sequencing. No consideration of how cash flows across the entire portfolio. And without that, even strong individual investments can feel inconsistent when combined. Because they weren't designed to work together. And this is where franchising creates a unique opportunity. Because the model itself gives you the ability to layer cash flows across different timelines. You can have upfront activity, ongoing recurring revenue, long-term value building, all happening at once. But it only works if you're thinking about it as a system, not just a series of deals. Now, let's take that one step further and think about what happens as the portfolio grows. Because a well-structured portfolio doesn't just scale in size, it improves in efficiency. Decision-making becomes faster because you've seen similar patterns before. Capital gets deployed more confidently because you understand how the system behaves. And over time, that creates an advantage that's hard to replicate because you're no longer reacting. You're operating from a position of clarity. And that clarity compounds just like capital does, because it allows you to say no faster. It allows you to focus on what fits, and it allows you to avoid what doesn't. Now, that alone protects returns in a way that most people overlook. Now, there's another layer I want to get into that doesn't get talked about enough, and that's energy, where your attention actually goes. Because a disconnected portfolio doesn't just impact financial performance, it drains focus. It forces you to split attention across unrelated problems, different models, different operators, different timelines, and that fragmentation slows everything down. But when a portfolio is structured as a system, attention becomes more focused, decisions become more aligned, and that creates speed. And speed, when paired with the right structure, is what drives outsized outcomes. So if you're looking at franchising right now, whether you're investing in one brand or thinking about building something bigger, don't just ask whether the deal makes sense on its own. Ask how it fits into the bigger picture. Ask when it produces cash. Ask how that cash can be reused. Ask whether it strengthens the system that you're building or if it just adds more complexity to it. Because the goal isn't just to make good individual investments. It's to build something that gets easier to operate as it grows. Something that starts to generate its own momentum over time. Something where each piece makes the next one stronger. If you get that right, the results don't feel random anymore. They start to feel intentional. And that's where the real advantage shows up. Now, that's exactly what we're building here at Empire Franchising. We're building a portfolio of brands that can all work together symbiotically. They're all in the home services business, or they're all in a similar space. This is what investors are looking for. A platform that is symbiotic. Everything works together joyfully.